if I get it well. There's been a change. We had earlier timetabled to run 1 to 5 as session 2, then 5 to 9 p.m. as session 3. But we are moving that session, which was in the evening, to the morning, to early morning, which is 8 to midday. We shall continuously put that reminder in the chat to ensure that you pick it up. You don't forget that 8 a.m. session. Now, I'll kindly request each of you to look at your mute button, because I'm already getting echoes. People are talking. You know, it's professional to check whether your talk is not distracting anybody. There are those who are not even talking, but still then look at whether your mic is muted, because you never know. You may talk at a particular time and distract the class. So somebody called Techno, mute your, yeah. So, I'm muting him and he's unmuting me. I'm muting him and he's unmuting himself. So let me continue, but I'll kindly request, I know that's got to distract you, but if anybody knows that person or can contact him on phone, I'm failing to unmute him, because I think even where I tried, he has unmuted himself and I can't mute him again. Okay, fine. Good luck, he has muted. Okay, fine. So we're back. So today's session, I'm going to concentrate on section B of your exam. So session 1, which is today. Please, today, I'm very sure you all know it's a Friday. Friday, 1st May 2026. We are basically going to cover section A questions. So, sorry, section B questions. Okay. Now, this section B questions, my focus majorly will actually be to look at questions that have examined key topics like IAS 19. Questions that have examined key topics like IAS 19. So IAS 19 is on employee benefits. So I'm going to look at a question that has examined employee benefits. Okay. Then I'll also be looking at a question that has examined a standard like IFRS 15. IFRS 15. IFRS 15 is about revenue from contracts with customers. Revenue from contracts with customers. Now, at one point, I'm going to change this laptop. I think its keyboard is a mess to me. So revenue from contracts with customers. Of course, I know you're aware of the spelling, so I'll deal with that later. So let me first introduce the standards or the areas that we're going to look at. Then I'm going to change. I'll ask for about 5 minutes to change the laptop I'm using at that point. Okay. Then I'll also be looking at a question that has IAS 33, earnings per share. IAS 33. IAS 33 is about earnings per share. Earnings share. Okay, so I'll look at that as well. So IAS 33 is about earnings share. I'll deal with that later. And then I'll also be looking at a question that could actually be talking about, say, IFRS, sorry, IAS 12. IAS 12 is about income taxes, but I'll focus or look for where we can get deferred taxes. Okay. So I'll look for specifically deferred tax because that's what I'm looking for in there. So again for that, but I know what we're looking for. I'm going to change this laptop later, a few minutes from now. Okay. So I'll also be looking at IFRS 16. IFRS 16. You all know that that's about leases. It's about leases. Okay. Then if time allows, I should also be able to look at IFRS 2. So IFRS 2 is about share-based payments. Share-based payments. Okay. So that is my major program today. If God allows, we should be able to do this. Of course, along the way, I could come across other standards. For example, it's very possible that I may come across a standard like IAS 37, which is about provisions, contingent liabilities, and assets. Let me just put it here, just in case we come across it. There are questions like IS, when you're dealing with IS 12, you may not run away from that standard IAS 37. So I-37 is provisions, contingent liabilities, and assets. Okay. So provisions, contingent liabilities, and assets. So we may not run away from it. I'm just putting it in the lot or in the list in the event that we come across it. We don't want to be surprised. So this will be my focus. Of course, when I go through this focus, my assumption and expectation is that you have read these standards. You've been taught these standards. If for those that are self-reading, yes, you've read the textbook, you've read materials, you've read class notes on these particular standards. So therefore, at this point, when you're left with just a few weeks, you're not asking me to teach you IS 19. You're not asking me to teach you IFRS 15 revenue. You're not asking me to teach you I-33 or IS 12 or IFRS 16 or IFRS 2 or IAS 37. But my focus is to actually apply those principles in the exam-based questions using the past paper exam questions to show you exactly how ICPAL would want you to focus those standards in an exam scenario. That's what we're going to do in this session. Okay. So let me just change my laptop, and I'm hoping that my colleague from ICPAL will actually admit me in back when I get there. So at this point, if you can give me about 3 minutes for me to change my laptop, that will actually be good for me. Thank you.
ndaje nyimuhe. Eh?
Guys, umuntu wa Tekino 45 yamyutinze ko bidufasha.
Mwese mwe muri kumva mwarimu?
Okay, people, so yes, I've been able to change my laptop to another. So let me just open the questions that I want us to look at. So I'm picking them from, I'm downloading them from ICPAL website. So please, a minute or two as I download them, because now I'm using a different laptop from the one that was failing to accept the keyboard. So Okay, so I guess I've been able to get a downloaded paper. Okay, so I want us to start on ICE 19. Remember, I've given you a focus of what we're going to look at today. And ICE 19 is one of them. So let me just share my screen. And then I'm able to move to that paper that I want us to look at or use. And we focus ourselves to those particular standards and the approach of those standards anyway, which is the most important thing. Okay, so I have a fresh new empty document because I have left the other one on the other laptop. So please bear with me on that. So today's our session 1. It is our May, which is on 1st May 2026. Okay. Remember that I'm focusing on section B questions. Okay. Now there are certain topics or areas or standards that come both in section A and section B. ICE 19 is one of them. So I'm first focusing on IAS 19. But even while I focus on IAS 19, which is titled Employee Benefits, again, I'm going to be very specific with which area in that standard is regular in our paper. And therefore, which area in that standard do you need to put a lot of your attention on? Okay, so in this case, we are looking at the defined benefit schemes or the defined benefit pension plans. Okay. Okay, so in that here, we are looking at the defined benefit pension plans or pension schemes. You can call them pension schemes. Okay, so when we do that, your exam, please, both in section A and section B, may or will usually want to see a student who's able to account for the change in that company's defined benefit pension plan, the changes or the movement, okay? So mean that here, your focus is going to be on how to account. The focus is how account for the changes or for the movement in the pension plan during the period. So usually our period is going to be a year for your paper, okay? Please, that is going to help you reconcile the opening balance to the closing balance. The opening to the closing balance of what is usually the net pension obligations account. Please, this net pension obligations account or balance is usually in the non-current liabilities balance sheet of the company. The non-current liabilities. Okay? But in certain cases, it could be a net pension asset. And the examiner can examine that as well. In most cases, practically, we shall have a net pension obligation balance, but we can also have a net pension asset balance. If there's any net pension asset position in a company, it will be usually in the current assets. So that's why it usually will be presented. So we want to reconcile the opening balance to the closing balance. And to reconcile the opening balance to the closing balance, we shall have accounted for how it has changed. In other words, the movement in that pension obligation or in the movement in that pension asset. Please, the word obligation can mean liability as well. So for those of you who are reading textbooks that they call it a net pension liability, it is correct. So it can be either a net pension liability or a net pension asset.
all we are looking at, or all we are focused on here, is to how to account for that change in the pension scheme. Okay. Now, in reality, when you're accounting, the following are the transactions. The following are the transactions that account for the change, the movement. Account for the change or the movement in the pension plan during the year. The accounting period is usually a year. Let me use the word period. Yeah? So one is that you may have, and usually you're going to have a current service cost. One can be a current service cost. So that current service cost could be the reason why your pension obligation, why your opening balance is not the same like the closing balance. Okay. Another could be a past service cost. Past service cost. I'll come back to talk about the entries for each of those. So a past service cost could be the reason why you could have your opening balance at the start of the year not equal to the closing balance, because there's been a change arising from a past service cost. Okay. There could be a net interest cost or net interest income. So you could have a net interest cost. At times it could be a net interest income. Net interest income. Okay. That could be the reason why your opening balance is not equal to the closing balance. Okay. There could be a case where there are contributions that have been put or paid into the scheme. Contributions paid into the pension scheme. So there could be a case where the company has put money in that pension scheme. Okay. It's also very possible that it could be the opposite, where you could be having a situation where settlements have been made. In other words, they have actually paid off the employees who are done with the scheme. Settlements of benefits paid from the scheme. So that could be another reason for the change. Okay. Now, all these are going to bring about what we call a remeasurement adjustment. So there could be a case of what we call remeasurement adjustments. So please, this remeasurement adjustments must be done at the reporting date. In other words, at the year end. They're not going to be done during the year. They are at a point in time at that reporting date. So there could be a case of a remeasurement adjustment. Okay. There could be a case which is not a requirement, but it can be an option, where we could have what we call an adjustment because of an asset ceiling requirement. So an asset ceiling adjustment. So as you prepare to go to this paper, and you know IS 19 is very regular in the paper, anywhere in the paper, section A or section B, the question you need to ask yourself is that, are you smart or clean with these changes, the 7 changes that can actually bring about that change in the opening and closing balance of this pension scheme? Remember, I'm looking at a defined benefit pension scheme. That's where my focus is. So are you smart with these 7 entries that the examiner can examine? He can even examine all the 7 in one question, in one scenario. He can examine some of the 7 in one scenario. Now, of this sum of the 7, the one that must always come is the current service cost. So this must always appear in your exam. So whether you want it or not, that must appear. Okay. So just like also the net interest cost must also always appear. So it must also always appear. The net interest cost will always appear. So the question is, are you good with that? Okay. Now, also contributions paid into the scheme, let me put it like it must always appear, because it's so regular in the paper. It will always, let me say, be in there. Okay? And also the remeasurement adjustments.
So those must always appear. So of the 7, we want to know, or we want to assure ourselves that 4 are always there. 4 of the 7 are always there. Okay? The 3 that may or may not be there, one of those will be the past service cost. It's not a must that it will always be there. It may come, it may not come, but be aware of how to deal with that. The second is the settlement of benefits paid from the pension scheme. It may appear, it may not appear. The third is the asset ceiling adjustment. It may not appear. 4 must always appear in the exam. Okay, so let me start with the how do we account for the current service cost if it appears. The accounting treatment here is that you are going to increase the expenses of the company. So this increases the pension obligations and the expenses of the company. And the expense implied here is that you are debiting the profit or loss, because that's where expenses are. Debiting the profit or loss expense, and you are crediting the pension obligations account. So you realize that the pension obligation is now starting to change, okay? Because there's a current service cost, and the current service cost implies that you are increasing that crediting a liability is increasing the liability, okay? Now, and this will usually be at the reporting date. This double entry is going to be at the reporting date, which is like the end of the year. This is at the end of the year. That entry is passed at the end of the year. Okay, so that's the current service cost. Now, how about the past service cost? So let's also see how the past service cost is done. Please, the past service cost is so similar to the current service cost. If you see, the English is that one of them is current, okay, while the other one is past. So another one is past, another one is current. They are basically both service costs. So because of that, also the past service cost is going to increase the pension obligations in the year or at the start of the year. And that means that you are going to run a double entry where you are debiting the P&L expense and you are crediting the pension obligations. Only the difference here is that this is actually going to relate to the prior periods. So I'll put in here to say which relates to the prior periods, not related to the current periods. And that's why they call it prior period, past service cost. So this relates to the prior period or prior periods, okay? Now, and usually this could be due to either an improvement, so they could have improved, they could have enhanced, they could have just changed. So it could be an improvement, or it could be an enhancement, or they could have changed. Let me use the word changed, because the changed here could actually even be a drop. So changed the pension entitlement to the employees. So those employees who are in this pension scheme arrangement, they could have enhanced, or they could have improved, or they could have dropped their pension entitlements related to the prior years, okay? Relating to the prior periods. So, and this is usually done at the start of the year, which is done at the start of the year, the start of the period. So mean that you are going to run your debit or credit, but that debit or credit is related to an improvement or an enhancement, or an let me call it a curtailment. It could even be a curtailment. Curtailment in English means that they have reduced. So that's the word I wanted to use as changed. The pension entitlement to the employees who are in this scheme in respect of the prior years, and the board made this decision or approved this decision at the start of the year. Okay, so the beauty about this is that this will adjust the opening balance. So the past service cost, will adjust the opening balance. So you adjust your opening balance of the pension obligation.
the pension obligation. So you need to be very mindful that we are going to run an adjustment of the opening balance with the past service cost. It's not an end of year entry. It's not like the current service cost where you're running end of year entry. Here you're running an adjustment of the opening balance. So mean that when indeed the opening balance maybe was 200 million, you're going to adjust it to 210 million if there's a past service cost of 10 million. So it's part of the change that has happened. Okay. And the net interest cost, the moment you're in the exam and you're being examined on the net interest cost, which will always come in there are two things you're going to do there. One is that you're going to compute it. So the first thing is that you need to compute it. And then the second thing you need to do is to recognize this net interest cost. Okay. So how do you compute it? You're going to compute it using what the examiner will give you as a discount rate or as an interest rate at the start of the year. The discount rate at the start of the year, not the discount rate at the end of the year. The discount rate at the start of the year. This examiner may give you both the discount rate at the start and at the end to trick you, especially if those two discount rates are different, to see whether you're picking a wrong one. So you're going to use the discount rate at the start of the year and the opening balance, the opening balances, okay? Meaning that you're looking at the balances at the start of the year. The year balances, okay? The pension obligations and the pension assets. Obligations and the pension assets. Please don't use the closing balance of the pension assets and the closing balance of the pension liabilities. We go with the opening balance. Okay, so the moment you've computed, the moment you've done this calculation, then that amount you've calculated, we go ahead to recognize it. So this is recognized in the financial statements. This is recognized in the financial statements by, so this will be the debit and the credit. So you're going to debit the P&L, which is a finance cost. So you'll debit the profit and loss account, a line called finance expenses or finance costs. Okay, that's the line you look for. While the credit goes to the pension obligations. Let me call it the net pension obligations account. We call the net pension obligations sits in the non-current liabilities. If this was a net interest cost, this would be a net interest cost. If what we had was a net interest income, then in that case we shall do the opposite. We shall debit the net pension obligations account, and then we shall now credit the P&L. And of course, you're crediting or looking for that line called finance. Okay, and this is for a net interest income. You have a net interest income. Remember, we may have a net interest cost. If you have a net interest cost, you're running this double entry here. Or we may have a net interest income. If you have a net interest income, the double entry runs in this direction. Please, this must always be there. The net interest cost or net interest income must always appear in the paper. At this point of the three entries that adjust our opening balance to a different closing balance, the current service cost we've said must always appear, and the net interest cost or net interest income must always appear. It's the past service cost that is optional. This may be examined. It's not a must that it will always be examined. So that may just be examined. If it's examined, I've already told you that always adjust the opening balance with the figure it tells you as the past service cost. Always adjust the opening balance and also the running debit entry of the P&L expense, date it the first date of the year, not the end of the year date. Okay. Now, number 4, contributions paid into a pension scheme. Please, again, those are usually going to be the exam. Usually, let me call it here. They always appear, but usually 99% cases they are in there. Please, the word here is paid. They must be paid, not payable. So, minute here, you need to remember that this must be paid. These must have been paid by the reporting date. They should not be payables. Not payables by the reporting date. So at the reporting date, the company must have made this money, paid this money into that separate entity. But the pension schemes are usually managed in a separate company or entity. So the company, this employer company, must have transferred these monies into that separate entity by the reporting date for us to call them contributions paid. So that word is, in past tense, they have been cash paid. So mean that this will be on a cash basis. This will be on cash basis, not accrual basis. So not accrual. So you don't say that, I have not yet paid them because my cash flows are not well, because the boss has not yet signed off that check. That will now become accrual. Okay, so we don't recognize contributions that are payable into the pension scheme. They must have been paid, and if they are paid, in that particular case, the double entry is that we are going to debit them in the pension assets account. So the pension assets will increase while the credit is your cash at bank, because you're paying them in cash. So your cash at bank will actually receive that credit. So those are the contributions paid into the pension scheme. Okay, other settlements in the pension scheme, those may appear, they may not appear. So it's not a must that they must be examined. They may be examined, they may not be examined. So let's again focus or emphasize that word, that these may be examined or they may not be examined. If they're examined, you only need to remember that a settlement implies that those employees that were entitled to their pension scheme have been paid off. Okay, so this implies that these are going to be settled. So these are going to be accounted for by debiting out the pension obligations. So the pension obligations and the pension assets. You're crediting the pension assets. So you credit the pension assets. Okay, so in other words, this basically reduces both the pension obligations and the pension assets. Is use both pension assets and pension obligations. So by you paying off these employees that entitlement, then the obligations to them go down. You've settled them. So the pension obligations go down, and you have used the assets in the pension scheme to pay them off. Okay, so that's number 5, entry 5, that will always be, that may appear. In the exam, it may also appear, and all you need to do is to run this double entry. The impact is that you have a net position of 0 on the net pension account in there. Now, remeasurement adjustments must only be done at the end of the year. One, you're going to compute them. So this must only be computed and measured after all the above 5 entries done. All 5 entries are completed. Okay, so you come now in to the adjustments. Okay, so this must be at the end of the reporting date. This must be at the end reporting date. Now, just like for the net interest cost, we shall have to do 2 things here. One is that we are going to compute that remeasurement adjustment. Secondly, you're going to recognize them in the financial statements. Okay, so let's start with the compute. So you're computing them as mathematical differences. So these are basically going to be mathematical. Let me call them balances. So these are going to be balances or differences. Okay, between the book values, the book carrying values, and the fair values. So the fair values, which will be given at the end of the year. So the fair value of the pension obligation or the fair value of the pension liability at the end of the period. Okay, this is basically for both the pension obligations and pension assets. So at the end of the year, you're going to run a calculation, a computation of those balances or differences between the book carrying amount and the fair values. And the examiner will give you those fair values, because this paper is not about you, looking for where the fair values are coming from, or that value at the end of the year. They'll give it to you. Use that figure to compare it with the book carrying amount. The book carrying amount would have been computed based on the 5 transactions that have changed the opening balance to a new remeasured book carrying amount. So that new remeasured book carrying amount, we shall again remeasure it to fair value. The differences are what we call the remeasurement differences. So I have computed them. The examiner gives you a tick and a mark for computing. When you're computing them, you're going to compute them and get them to the net figure. So here we shall have this computed to a net amount. Is that net amount could be either a net remeasurement gain or a net remeasurement loss. So that is to say, either a net measurement gain, a net measurement gain, or a net measurement loss. A net measurement loss. So it will depend on what we've gotten in our calculation. Do we have a net remeasurement gain or do we have a net remeasurement loss? The moment we have computed that net remeasurement gain or net remeasurement loss, we go ahead to now recognize it. We recognize it by debiting the other comprehensive income. Please, this is taken to the other comprehensive income. So we shall debit at the other comprehensive income while we credit that net pension obligations account. The net pension obligations account. If we have a net remeasurement loss, this will be if at least we have a net remeasurement loss. So the moment you have computed a net remeasurement loss, then that net remeasurement loss is going to be debited in the other comprehensive income, while the credit is taken to the net pension obligation. If I had a net remeasurement gain, then in that case, I will have the reverse entry. I'll have instead a debit of the net pension obligations account, account, and then the credit this time around will be the other comprehensive income. The credit is the other comprehensive income. This is where we have a net remeasurement gain. A net measurement gain. Okay. Otherwise, in certain cases, you may have what we call an asset ceiling. You may have an asset ceiling. Please, an asset ceiling adjustment will only arise. This may be examined. It's not a requirement that it will always come in the exam. It may be examined. Please, the asset ceiling will only arise where you have a net pension asset position. Net pension asset position because at that point, when you had your pension obligation closing balance or remeasured to fair value balance, it was lower than the remeasured net, the remeasured asset level. So here, we shall say that this only arises where the defined benefit pension scheme, defined benefit pension scheme is in a net asset position. Is in a net asset position or balance. Let me call it balance at the reporting date. As the figure for the pension asset is bigger than the figure for the pension obligation. In reality, it's not very common that the pension assets, a company can maintain pension assets that are higher in figures or balance than the pension obligation. Just imagine if I have these 20 employees and I committed that I'll pay them in addition to their normal salaries, I'll give them a benefit at the end of the contract. My duty is to assess that obligation because I've now committed myself to an obligation. If the amount of obligation I have, let's say, is supposed to be assessed to be 20 million, and I've been advised professionally by that person called actuary that you have an estimate of 20 million as the obligation arising from that commitment you have with the employees. There's no reason, commercial reason, by the way, that should force me to put 25 million, say above 20 million in the pension scheme if I need that 5 million for other liquidity reasons. So in most cases, I'll put that 20 million there, or I'll put slightly less than 20 million to have a net obligation position, that amount I've not put in there is still an obligation that I have to put in that pension scheme. It will be very rare if your pension obligation is 20 million, as estimated and advised by the actuary, and you're putting 25 million, for example, in the pension scheme. Yet you will need that money for liquidity purposes for some other things. So if it happens, then you have a net asset position, or net asset balance. So an asset ceiling adjustment will only arise when the defined benefit pension scheme is in a net asset position at the reporting date. In which case, therefore, prudently, we need to reassess whether the company is able to recover or utilize that pension asset, that net pension asset position is able to recover. So are you in a position where you can be able to recover, or you are able to utilize that net pension asset? To the extent that you may not be able to utilize all of it, then the amount you cannot utilize, or the amount by which you can only utilize, becomes the asset ceiling. Okay, so where maximum amount that net pension asset, maximum amount, the net pension asset that can be utilized, which can be recovered or utilized, becomes our asset ceiling. So it's the maximum. So this becomes the asset ceiling. So the moment I have an asset ceiling, that I'm going to run an adjustment. For example, if I had overfunded, let me use that word, you've overfunded. You only need to have 20 million as pension obligations, but you've put 25 million. So you have overfunded by 5 million. And you can only recover 4 million. So your asset ceiling is 4 million. That 1 million you can't recover is going to create an adjustment. So we're going to adjust. So that adjustment by implication is called an impairment. Okay? So therefore, any amount of the net pension asset, amount of the net pension asset above asset ceiling, above the asset ceiling, is written down. The asset ceiling amount, by or through an adjustment, asset ceiling adjustment. So that asset ceiling adjustment, first we are going to compute it, asset ceiling adjustment, okay, which is indirectly an impairment loss. So this is an impairment loss. So as if that asset you wanted to raise and put in your financial statements is impaired, and therefore you need to first have it computed. So we shall first have it computed. So it shall compute that loss or that adjustment. Okay, then we shall go ahead to have it recognized. So how do we compute it? We shall compute it by looking at the figure you've just called the net pension asset minus the asset ceiling. That's the amount minus the asset ceiling amount. Minus the asset ceiling amount. So that's how you mathematically calculate it. After you've calculated it, then you go ahead and recognize it. So how do you recognize it? Recall that by implication, it's going to be an impairment loss. So you're going to recognize it by debiting what we call the other comprehensive income, while the credit shall go to the net pension asset. So when you credit the net pension asset, you have written it down because it's impaired. You have reduced it by that amount that the company cannot be able to recover. So you have overfunded. If I go back to my example, you've overfunded the scheme by 1 million, sorry, by 5 million out of 20 million obligation. For you put 25. So you've overfunded, you've overput money there by an extra 5. So the first thing is to check and assess whether you can never recover back all that 5, which you overfunded in the scheme. If possibly you will not recover all of it, and you can only recover up to 4 million, then the asset ceiling is up to 24 or up to 4 million. That extra 1 million, which you can't recover, is going to create what we call an asset ceiling adjustment. So that asset ceiling adjustment shall imply that it's impaired. You cannot have all the net asset of 5 million. You can only recover 4. So the 1 million you can't recover is an impairment loss in that asset, in that net asset, which we shall now credit it out or reduce the asset by that 1 million while we debit it in the other comprehensive income. We shall debit it in the other comprehensive income. So please, the exam, it's not a must that the examiner will always or must always examine an asset ceiling adjustment, but if it comes, you need to do 2 things. 1, compute it. Secondly, recognize it. And only recognize it with 1 entry called a debit, or sorry, a debit of the other comprehensive income, and the credit is the net pension asset. Don't say that, Bruce, isn't it possible that we can credit the other comprehensive income and then debit the pension asset? No, you will always and only debit the other comprehensive income. It's a debit, it's a loss, you know, it's an implied impairment loss. And then you credit the net pension asset account. Please, in your process of getting ready for this paper, IS 19 is regular, anywhere, section A or section B. I'm focusing on section B today. It's regular in the sense that it's always examining a net benefit pension plan or net pension benefit scheme. But in all ways, the examiner is looking at a student having the capacity to account for how that pension scheme has changed from the opening balance at the start of the year to the closing balance. And what has changed it? What has changed it is the changes in the year. In total, there are 7. Those changes in the year have changed our opening balance to a closing balance, whereby in the year, there will always be a current service cost. In the exam, they'll always examine it. And they want to see a student running that double entry in the exam, okay? Then at times, there could be a past service cost because at the start of the year, they made an adjustment or an amendment or an enhancement or a curtailment of their pension scheme to the employees in the scheme purposely for the prior years. And when that happens, it means that they are adjusting the opening years through a debit of the P&L and a credit of the pension obligations account. And that must only be at the start of the year because it relates to the prior years. In the exam, it's not a must, it will be examined. It may be examined. The moment it comes, just know that you're running that kind of double entry. Fine. Otherwise, in the exam, you'll always have a net interest cost. That one, you will not run away from it. First, you'll need to calculate it. Secondly, you now need to recognize it in the financial statements. Calculating it could be the problem to students because they don't know that they always have to use the start of year discount rate and the start of the year balances. The start of the year balances for the pension obligations and the start of year balance for the pension assets, you need to calculate it. If you start computing using the end of year discount rate or end of year balances, you're starting to run it bad. You're starting to run it dirty. You're starting to get it wrong. Okay, when you've calculated it, then you are now going ahead to do a debit and credit, where you are saying that in case it's a net interest cost, I'm debiting the P&L and crediting the net pension obligation. The opposite for a case of a net interest income, I'm debiting the net pension obligations and crediting the P&L. Always in the P&L, you're looking for a line called finance costs. Whether it's a net interest income or net interest cost, you're looking for a line called P&L, sorry, a line called finance cost. Then, as a student, you're also saying that I am able to account for the contributions that have been made this year into the pension scheme. They must have been paid, not payable. They must be on a cash basis because the credit entry must be cash. There's no way you'll say, I'm crediting cash when the company had not yet paid it. It was on an accrual basis. It must be paid. So the examiner can trick you to say that in total, the contributions this year is 10 million, of which 8 million has been paid and 2 million will be paid one day or 1 week after the year end. So it's trying to trick you to see whether you're going to say all the 10 million I'm crediting cash. Really, you only had 8 million, for example, to credit cash. So mean that your debit must be pension assets of only 8 million. The remaining 2 million is a contingent asset under IS 37. Just disclose and write about it in the notes rather than saying I'm debiting it and crediting it on the face of the financial statements. There could be a case where employees who have been in the scheme have completed their journey and are getting their entitlement, which comes in form of settlements of these benefits. It may be examined. Don't think that that must always be there. If it comes in the exam, then take it that therefore the pension obligations and the pension assets have reduced through that settlement, and I'm therefore debiting the pension obligations and crediting the pension assets. That has also created a change in the pension scheme. Okay, please don't think it must come, but it may come. If it comes, that's the double entry. Otherwise, you must always compute remeasurement adjustments, which are only done after all the 5 entries above have been done. Don't start saying that, Bruce, let me start with the current service cost, then let me do remeasurement adjustments, then the number 3 I will do will be past service cost, then the net interest cost. You'll be very terrible and funny. The remeasurement adjustment is done after all the other 5 have been done, because all those other 5 are going to be yielding, or are going to actually be able to run us the book carrying amount. So the book carrying amount is based on all those 5, and then the examiner will give you the fair values of the same pension scheme at the end of the year, for which you're saying that the mathematical difference between the book values, which have come from the 5, and this fair value which the examiner has given you, that mathematical difference is what you've computed. When you compute it, you call it a remeasurement adjustment. Either it could be a remeasurement adjustment in form of a net remeasurement gain, or in form of a net remeasurement loss. Whichever it is, you need to compute it correctly, and you need to go ahead and recognize it. But why do you recognize remeasurement adjustments? In OCI, not in the P&L. So if it's a remeasurement loss, you're debiting the OCI. If it's a remeasurement gain, you're crediting the OCI, where the corresponding entry goes to that net pension obligation account or net pension asset account. Usually it's a net pension obligation account. It can only be a net pension asset account in rare cases where now the asset ceiling comes into play. Please, the asset ceiling is not a must-read exam that they'll examine it, but in the event that you have that rare situation, that your pension scheme at the end of the year, after remeasuring it, after all those 6 entries, has given us an asset position, then don't rush to say that this is the net pension asset. Remember, net pension asset goes in the current assets. Don't rush to put that figure in there until you double check whether the examiner has told you whether you can recover, whether the company is able to recover or utilize that net pension asset. If some of the net pension asset is not utilizable or recoverable, then we need to write down that we need to compute that asset ceiling adjustment, which is implied to be an impairment loss. First, calculate it. In other words, the mathematical difference between what can be utilized, that asset that can be utilized, against the book value asset that you had. That difference is the amount we need to adjust, and then we need to always take it to the OCI as a debit entry. Okay, so I want us to use this experience to go to a section B question that has been examined before in the April 2023 exam. 2023 exam, A1.3 exam. Okay, there was a question number 2. There's a question number 2 in there, and I'm going to start with part A of that question number 2. But before I do that, let me just check in the chat whether I have some questions. I'm looking for any questions that are specific on ICE 19 for me to address. Or somebody saying that, can I get the difference between past service cost and current service cost? So that question came from somebody called Ngabo. The difference between current service cost and past service cost, that word current and that word past. One, we say that current service costs are normal every year, just like salary. Every end of month, I'm assuming yesterday, 30th April, it was normal, people earned their salaries. You got your salaries. So that was your current service salary for the month. Let me call it the current monthly salary as at the end of April is a current service cost to your employer, sorry. Let me repeat. At the end of the month, like April, when you got your salary, to the employer, that was a current service cost. It was a current month cost, a current month employment cost to the employer. But if your employer yesterday or in the month of April says, I have improved your salary from 500,000 per month to 600,000, and this starts from 1st January. So January, February, March, they already paid you your 500,000, but they are now increasing or enhancing it by 100,000. Then the 3 months that you did not receive your 100,000 extra, if they're paying it in April, we shall call it in April a past salary increase. it's a past salary, a past month or a past 3 months salary increase. It's a past service cost. So that's why here we are saying that technically in accounting, for the current service cost, you're still debiting expense and crediting obligations. Also for the past service cost, you're still doing the same entry. But the difference is that for the current service cost, you're dating it end of the year to account for the fact that it's for the entire month. So end of the year, end of the month would have been 30th April, or end of the year will be the end of year date. Yet for the past service cost, we date it start of the year. We date it start of the year. If I was talking about that month, April, would say 1st April. So on 1st April 2026, these are the additional past service cost for the month of January, February, March, 100,000 for each of those 3 months. In total, that's 300,000. So that amount will adjust the opening expense of this company. That at the start of April, whereas we had paid 500,000 times 3 for the 3 months, January, February, March, which was 1.5, we're adjusting it upwards from 1.5 to 1.8 because there's this 100,000 which we've increased over the 3 months, but we've increased. The amendment has been done and approved by the board at the start of April. So that's the difference. So the difference is one is for the current month, the other one is for the past month. If I go back to our pattern of the period in the paper, one is for the current year, the other one is for the past or the prior years. That's the mathematical difference, sorry, the technical difference. The accounting entries are the same, only that one is dated start of the year, the other one is dated end of the year. The one that's dated start of the year is looking like it's adjusting the opening balance. So Ngabo, I hope that addresses your question. Okay, so I think that was Ngabo. So another person said, is interest calculated on adjusted opening balance with past service cost? Correctly. Somebody is far better than us already. Well, let me go back to this computation, back to number 3, net interest cost, because you're using the start of the accounting period date, so the start of the discount rate at the start of the year, and the balance at the start of the year. We shall say that where applicable, where a past service cost, where past service cost was recognized, then in this case we use the opening balance. Let me call it the adjusted opening balance. Let's call it opening balance adjusted after the service cost. That was a good question from that person. You're actually showing me that yes, you're trying to really follow. So yes, the net interest cost will be based on an opening balance that you have first changed or revised or adjusted because of that past service cost. Okay. Okay, so okay, I think those were the questions that were asked in the chat. I'm looking out for questions that are technical on IS 19 from those who have written their questions in there. And those are the ones that I'm addressing. So can I go to that question then, which we want to look at? So if opened the April 2023 exam, which I've opened here, April 2023, and I'm looking at specifically question number 2. I'm enlarging this so that we're able to see it better. Question number 2, part A. Okay, so question number 2 here it is. Then I'm dealing with part A. So part A is the one that has the pension scheme, if you see there, the pension scheme. Okay, quickly, always look at the requirement first. So they are telling me that show the accounting treatment. So accounting treatment is about the double entry, debit and credit. Okay, so we're going to show the accounting treatment for the above pension scheme in the financial statements of Butera Engineering for the year ended 31st October 2021. So whatever we do, our focus is that year ended. Specifically, they want you to look at the movement or the change comprising the changes in the values over the year for the pension obligations. Okay, so the changes in the year for the pension obligations. Part 2, the movement comprising again the changes in the values over the year for the pension assets. So we also have the pension assets in here. And then number 3, they want you to develop or to prepare or to show an extract of a summary transaction figures as they will appear in the statement of profit or loss and other comprehensive income. Okay, so the figures as they would appear in the profit or loss and other comprehensive income. They want a summary of those figures that will be the P&L and in the other comprehensive income. So at the start of this scenario, they're telling me that Butera Engineering is a local company. It's listed on the stock market. It specializes in manufacturing large construction equipment and machines. This company has 4 main factories in Rwanda, and they employ over 100,000 employees who work in these factories. Now, this company has a financial year ending 31st October, and they've given us transactions for this year ending 31st October 2021, starting the pension scheme in Part A, where they're telling me that the company operates, and I hope you can say, a defined benefit pension scheme. There it is. It's a defined benefit pension scheme. Okay, for the employees they use in the factories. And this scheme has pension assets that are held in a separately funds that are under the control of trustees. So you see they're being managed separately, usually in a separate entity. And the company is looking for your advice regarding the computation. You see, there are cases where you cannot run away from computing, and then the accounting treatment, the recognition. So computing and recognizing. So the company has come to you, you're the expert. It's asking you to help them with the computation or the accounting treatment of the pension scheme or the pension plan. Okay. Now, below is the information relating to this pension scheme in the year ended 31st October 2021. So they've given me the pension value of the obligation at the start of the year, because if the year will end October 2021, so this is the opening position, that on 1st November 2020, the pension obligations, because this is the pension obligation at the start of the year, was 28,000 million francs. So that's the figure there. Okay. While at the end of the year, October 2021, the pension obligation is closing to 33,600. So you see, we need to reconcile, we need to explain the change in the year for the pension obligation. The opening balance was 28,000, the closing balance is 33,600. So the change in the year could be some of those 7 transactions we talked about. The same also comes to the assets, that the pension assets at the start of the year, November 2020. So November 2020, they started with 26,600. By the end of the year, the pension assets have gone up to 31,500. So the pension assets have also gone up to 31,500. So again, the question is what happened? So there's that change of movement in the year for pension assets that we need to account for. While we do that, we take into consideration that we had our 7 transactions that can change a pension scheme. Now, always they will ask the current service cost and they will give it to you. Always. Stay. Okay? Always they will tell you the pension. No, it's not always. These are the benefits paid. But usually the contributions, here it is. The contributions paid always will be there in the exam. Okay? Always you'll have to compute and recognize the net interest cost. You'll always also have to compute and recognize the remeasurement adjustments. Those 4 things. Those 4 things. Please remember that I've told you that we have both started on a fresh page today. These things I'm writing, I'm hoping you're writing them. Some of these things I'm talking and I'm not writing them. Some of them I'm writing them that this must always be examined. Current service cost will always appear. Or the net interest cost must always appear in the exam. Or the contributions paid in the scheme must always appear. Or the remeasurement adjustments must always appear. Those 4 things, write them. Don't wait for this document. ICPAL may not even give it to you. Let me tell you, it's not a requirement for ICPAL to give you its document if you already have the class addressed to you and you have your pen and paper with you, because that's part of learning. So if it has not given it to you, don't fail because you need to do your own writing, especially if I'm repeating and repeating myself. I'll run my duty to pass over this document. It belongs to ICPAL. It does not belong to me anymore. So people are going to write in the
what's that? WhatsApp to say, give me Iqbal's document. I'll be doing it illegally, so I'll not commit that illegal offense. But again, Iqbal is not required because this is like a blackboard. You know, I'm like in front of a blackboard and I'm writing. If I rub it off, don't say, or don't even say, take it home. Please write. Let me repeat the 4 things that must come. Everyone you see, defined benefit schemes. Current service cost must always come. I'm repeating it for somebody who has not been writing. He has written it somewhere. Again, that person has written that net interest cost must always come, in which in the exam they will always want you to compute it yourself. You are the one going to compute it yourself. Because you're going to be the one to compute it, they may not write it here for you. They will not write it here for you because they want you to be the one to compute it yourself. So you're about to ask me, how come I'm not saying it there? Because as I've written here, you must compute it. Then you must go ahead to recognize it, but it must always be there. Number 4, what must always be there is the remeasurement differences. Again, they will not give it to you because you must compute it yourself. So don't say, Bruce, I'm not seeing it here, the remeasurement adjustment. No, you are going to compute it yourself. So there's no figure for it here. The examiner will not give it to you as a figure. He will expect you to compute it. Then you go ahead to recognize it. What may come or may not come can be a past service cost. That one is not a must that it can come. It can come, it may not come. What may come or may not come is the settlements for those employees who have completed and they are settled. Here, if you see this question, that one came. This bit pension benefits paid. So it came, but it's not a must that it must always come, but it can come, like there it came, okay? Again, what can come or may not come is the asset ceiling adjustment. It only comes if you have a net asset position. In most cases, you'll have a net obligation position, okay? So having said that, let's go back to our question. So they're telling me here that the interest rate, please, the interest rate is that discount rate. So the interest rate on a high corporate bond for the pension plan is, so you see, we have the one at the start of the year, November 2020, it's 7%, and there's one at the end of the year. Please, the one at the end of the year, ignore it. If you remember, so they're starting to tell you that for you to compute that net interest cost, which you must always do in this paper, they want you to use the interest rate at the start of the year against the start of year balances. We already have our start of year balances for the pension obligation. The start of year balance is 28,000. That's the obligation brought forward. For the pension assets, the start of year balance is there, 26,600. And the discount rate or interest rate at the start of the year is there. So he has given you the information to compute it for yourself, that net interest cost. Okay. Then it comes to tell you that the remeasurement differences are recognized in line with IS 19. But he has not told you how much they are. And the student is saying, now where are they? You are going to compute them yourself. After all these 5 transactions are in there, if they are there, if the 5 are all there. For example, your past service cost will not be there, but current service cost is going to be there, number 1. Net interest cost will be there, number 2. Contributions paid to the scheme will be there, number 3. Settlements paid will be there, number 4, in this question given to us. So after we put all the 4, then we are going to do our remeasurement adjustment because it comes after all of those above. When you will do that, we shall compute it ourselves. And then go ahead to use the statement he has told us that in accordance with IS 19, they are going to be recognized, but we recognize them in OCI. So he's just telling you that in accordance with IS 19, to tell you that the other compressive income. Others, he's telling you that contributions paid and the benefits were withdrawn exactly within the year on the last date of the year. So they are cash paid. Even he's trying to emphasize that the contributions were cash paid by the end of the year. They were paid. So required again. They want me to show the accounting treatment for the above pension scheme. The financial statements for this year ended October 2021, specifically the changes in the pension obligations, and number 2, the changes in the pension assets, and number 3, a summary of the figures we shall put in the P&L and the other compressive income. Okay, so let me go back to my document here. I know that my students now are excited to write.
even those who are just looking on, enjoying their drink and eat, they have now picked up paper, because you'll not benefit, you'll not bring that, you'll not go in the exam empty-handed in this open book, the last open book you're having, to say, oh, Iqbal has not given me the paper, the blackboard where they wrote. They have given you opportunity of the revision session to use it for your own tips to write, which you'll summarize or which you'll write in full and go with in the exam, expecting most cases ICE 19 to be in that paper, and defined benefit schemes in the paper. For transactions will always be there. Okay, so I'm going to start with number 1, or I, which is the movement, the changes in the pension obligations account. Pension obligations for the year ended 31st October 2021. Okay, so let me use a table. I think it's better to insert a table here. Okay, so let me use this same approach for also number 2, which is going to be the movement or the changes in the pension assets. So pension assets. Of course, you're so opening yours up. Maybe you're leaving about 7-8 lines there. Okay, and whatever impacts on the P&L, I'll have those figures in summary as they should be presented in the P&L loss, and also in the other comprehensive income, OCI. Okay, so I can put a table just to be orderly anyway. Okay, so I have this in the P&L. And also, I want to do the same for the other comprehensive income. Okay, so if I go back to my question, I'll say that ideally, they told me that in this year, we had an opening balance for the pension obligation, 28,000, that figure there, 28,000. So I'll come and place it in the right line there, or right area here. So I'll come to number 1, pension obligations. I'll say opening balance at 1st November 2020. Okay, and the figure they've given me is 28,000. But the R figures are in thousands. Let's see. Let me try to see the round-off factor. Million francs. So they're million francs. So let's respect being very ordered to say francs. For both pension obligations, pension assets, the figure we shall find in the P&L, and the figure we shall summarize in the other comprehensive income. So I'm just trying to make that orderly. So my 1st November opening balance, 1st November 2020, for the pension obligations is 28,000. Okay, so I have 28,000 in there. Then I'll move back and see that when I went back, they also told me the present value of the pension obligation at the end of the year, 31st October 2020, 2021, sorry, I have 33,600, this figure here. So I could leave like about 3 lines maybe in between, or 4. I could come in here and say that I could put it somewhere here. the space will be enough. Let me insert just 1 or 2 more lines to be on a safe side. Okay, so I'll come in here and say that my present value of the pension obligation at year end. Our year end is 31st October 2021. So the figure they've given me, if I go back to pick it up, is 33,600. So 33,600. So whatever I'm doing across the year, I'm trying to ensure that that opening balance is reconciled to the closing balance by changes in the year. So there are going to be changes in the year that I'm going to account for. When I account for those changes in the year, I will finally come to also account for the remeasurement differences. Okay, so I want to do the same also for, sorry, this is one. So I want to do the same for the pension assets at the year end in number 2 down here. For number 2, we've not yet done opening balance. Let's pick opening balance from the information given. Can I use, let me just put this at the end so that on a fresh page, so that everything is well seen. Okay, so if I go back to the information given to me, for pension assets at the start of the year, 1st November 2020, they've given me 26,600. 26,600. So let me go and put that there. So I have 26,600. 6,600. Okay. Then at the end of the year, I see assets are 31,500. 31,500. 31,500. So that's the figure at the end of the year. So it's going to be market value or fair value. Let me leave a couple of lines there so that, again, I don't run out of space. Okay, so fair value, the pension assets at the year end. Our year end, in this case, is 31st October 2021. Okay, and the figure they've actually given me is 31,500. 31,500. Okay, so what I'm doing is I'm posting these figures. In the exam, you're earning marks. Those are half mark, half mark. They call them posting marks. You're posting them rightfully. Now, as a must, there's a current service cost. I have a current service cost. So what do I do with the current service cost? I remember, perhaps I can put it down here to say that these are basically my accounting journals or my workings. These are my workings and accounting journals. So my current service cost, I am debiting it in the P&L, okay, as an expense, while I'm crediting the pension obligations account. Crediting the pension obligations account. From the figures or information given to me, that figure is 2,800. 2,800. So I'll pick and say 2,800. Okay, so I want to post it. I will debit the P&L expense. I already have the P&L summary here, where I'll come to the P&L summary and say, I have a current service cost. Okay, and it's 2,800. It's a debit entry, 800. Okay, the credit, I'm taking it to the pension obligations account. Pension obligations account. So my pension obligations account is part 1 or item 1 here, where I'll come in to say that now a credit is a plus. So an obligation is credited with, so it's increased with that credit. So you're putting a plus there so that I have a current service cost. Okay, and that's 2,800. Okay, so that is it. So that's the first thing I've seen in the table. They've also now given me the benefits that have been paid, and the benefits paid at 2,660. 2,660. So let me also go and just show the accounting journal here. Working 1 was the current service cost. Working 2 is the benefits paid.
pension benefits paid. Double entry is that you are debiting the pension obligations account. You are crediting the pension assets. That's what is that you are debiting the pension assets. Sorry, you are debiting the pension obligations account, effectively reducing the pension obligations, and crediting the pension assets account, effectively reducing the pension assets by 2660. 2660. So let's go and post that as well. So I'll go to the pension obligations account, which is item 1 here. A debit of an obligations account, an obligation is a liability. If you're debiting a liability, it's a less, you're reducing. So I'll come in here to say, reducing it to the pension benefits paid. Pension benefits paid, so which is 2660. 2660. Okay. And I'm also doing that on the pension assets account because I'm crediting the pension assets account, which is here, number 2 here. So I'll come in here to say minus the pension benefits paid, 2660. 2660. Okay. So that is also posted. Then I come back. The next thing I have here is at 2380, which is the total contributions paid into the pension scheme. And they were paid in the year because they were paid down there. We're told they were paid on 31st October 2021. 2380 is the cash payment for the contributions. So pension contributions paid. So let's also go and deal with that in our answer. So let's reflect its working here, or entry. So working 3 is the contributions paid. So this must have been paid into the pension scheme. Okay. Remember that for this, you are debiting the pension assets account. Okay. While you are crediting cash, it's a cash outflow. Okay. And this here will be, let's see how much they've told us. They've told us that this is 2380. 2380. So this will be with 2380. Okay, so let's post that as well. Here we are going to post the debit entry because we are not ideally preparing a cash account in our journals or in the requirement. We're only preparing the pension assets and the pension obligations. So I'm debit on the pension assets is a plus. So let me open that number 2, which is the pension assets. A debit is a plus. I'll say the contributions into pension scheme. Okay, 2380. 2380. Okay, so again, remember that we picked this right from the scenario. Okay, then at that point, that table is done, and students think they are finished, forgetting that now have to do the other 2 remaining entries that must always be examined. We're now going to compute the net interest income and then recognize it, and then second, we'll compute and recognize the measurement adjustment or measurement difference, which now goes back to my working. That in my workings, now I have a working for, which is the net interest. So that net interest, we need to determine whether it's a net interest cost or net interest income. And we're going to use the discount rate or interest rate at the start of the year, which was 7%. Don't use 8%. 8% is end of the year. For us, we go with start of the year, which is 7%, and also start of year value, like start of year pension obligation is 28,000. Start of year value for pension assets is 26,600. Okay, so let's go and deal with that. So I'll come in so that I'm starting with the interest expense. Put a table kind of, will be much presentable with a table. Okay, so I'm starting with the interest cost on the pension obligations. Interest cost on the pension obligations. Remember, I'm using the interest rate at the start of the year, which is 7%. Okay, the pension obligation at the start of the year. Our pension obligation at the start of the year, if I pick it from my figures in here, is that 28,000. That 28,000. So I'll take it down there. If we had had a past service cost for that question that came from whoever it came from, I would have said plus the adjusted pension obligation with that past service cost. So here I have 28,000. It was not an adjustment. I didn't have any past service cost to come in there. So 7%, I'm using my calculator, times 28,000. I have something like 1,960. So 1,960. Okay. Then you have your interest income. Interest income on pension assets, which is again 7%. I'm using that same interest rate at the start of the year, times the figure of the pension asset at the start of the year. From my table up here, the pension asset at the start of the year was 26,600. So I'll bring it down here to say times 26,600. Okay. Again, I'm going to use my calculator. 7% times 26,600. I have 1862. 1,862. So you see that the interest expense or cost is bigger than the interest income. The 1960 is bigger than 1862. So in this case, I have a net interest cost. Net interest cost, which is mathematically the difference between 1960 minus 1862. So my net interest cost, if I use my calculator, is 1960 minus 1862. I have 98. My net interest cost is 98. So now that I've calculated it, so the first thing I've done here was to get it computed. So you don't expect the examiner to have given you that figure. Now I want to go ahead to have it recognized. So I'll recognize it by debiting. Because it's a net interest cost, I'm going to debit the P&L, a line called finance cost. Finance expense with that 98. So this is with a net interest cost. With net interest cost. If it was a net interest income, I'd have credited the P&L, that line called finance cost. Okay, so I have a debit there. Okay, so where are my credits? I'm going to credit. Let me first go with the credit. I'm going to credit, and I will skip a line there because I'll bring another debit later. But I'm going to credit. Sorry, I'm going to credit the pension obligations account with the interest cost on the pension obligations. Pension obligations with the net, sorry, with the interest cost on the pension obligations. What was that figure computed? It was 1960. Okay, while now the other is a debit of the pension assets with the interest income on the pension assets. So that interest income on the pension asset was the 1862. 1862. So that's the double entry I'm looking for. I have first computed, and the examiner is very happy with that computation. I've now gone ahead to recognize. So the recognition is what I want to post. So the debit in the P&L finance cost of 98, I'll take it to my P&L summary up here. So I have my P&L summary here, where I say I have a net interest cost, which is coming from my working for below. And that net interest cost is 98. It's a net debit of 98. I have a net debit of 98 there. So I've posted the debit entry in the profit or loss as a line called net interest cost, because that line is in the finance costs. That line stands in a line of finance costs. While the current service cost could stand in a line like administration costs or other expenses. The net interest cost must always stand in a line called finance costs. Okay, so if the debit is thrown, then now I need to take the credit. So the second debit, the pension asset, I'm debiting. A debiting of a pension asset is a plus with 1862.
So I'll go in there and say that I'm putting, and go up there and say net interest, so the interest income on the pension asset. So I'm going up to number 2 here, which is this, to say plus, because you're debiting, so you're saying plus, that's interest income on the pension asset. I will tell the examiner, look at my computations working for, and the figure I had there was 1862, 1862. So that's the second debit. So I've posted the second debit. Okay, now I'm left with just the credit, which is the interest expense or interest cost on the pension obligation, which is 1960. So I'm going to go up there in number 1 where I had the movement or change on the pension obligation, and a credit is a plus. So pension obligations increase with the credit. So I'll go in there and say plus. Plus the interest cost on the pension obligations, and I want to refer to the person marking my script to go to see what I've put in working for, and I'll tell the examiner or the marker that I have my 1960 from down there. Okay, so where are we now? We've done the interest cost, and we've actually the net interest cost, and we've actually computed it using our working for. After computing it, we recognized it. So mean that now in my scenario, I'm left with the remeasurement adjustments, which they are talking about here, or remeasurement differences, which I should take to OCI because I need to have them recognized in line with IAS 19. But for me to recognize them, I need to first compute them. But for me to compute them, I need to have completed first these other transactions that should give me what we call the net book value or the revised book value. So let's go first to the pension obligations here, so that I have my book value, my book carrying value, the year end. Remember our year end is 31st October 21. So I'm going to run a mathematical calculation with a calculator, running these figures here. So that at the year end for the pension obligations, which started the year with 28,000, I'll say now plus the current service cost of 2,800. Then I'll say minus the pension benefits paid of 2,660. Then I'll also say plus the interest cost of the pension obligation of 1,960. Ideally, as I have 30 or 30,100. So my book carrying amount at the end of the year would be 30,100. Yet my fair value or present value is 33,600. So the difference here is what I'll call a measurement difference. So I have a measurement difference. So that's the measurement difference. I have computed it. Is this remeasurement difference? Must be at the year end, 31st October 2021, where I'm mathematically looking at the difference between the 33,600, which is the present value or the fair value down there at the end of the year, minus the book carrying amount of 30,100. So your examiner is expecting to give you a calculation mark because you're using your calculator. You get 33,600 minus 30,100, and in there, my calculator says 3,500. So I have a 3,500, which I need to interpret. If my book value of the liability was 30,000, now it's 33,000. It has increased to close at 3,300. It means that I have lost out. You know, if a liability goes up, if you had a payable of 30,000 and it's now say close to say it should be 33, then I have a remeasurement loss. This becomes a remeasurement loss. So this is a remeasurement loss. So I have a remeasurement loss that I've completed. Okay. So let me put it in a color red for you to pick it up, because your examiner says this student should know how to calculate that remeasurement and also should know the type of remeasurement. Is it a remeasurement gain or loss? So I have a remeasurement loss on the pension obligation. Obligations of 3,500. Okay. So let's also go and do the same on the pension assets. So I'm moving down to my item 2, so that on pension assets, for that I need a book value, sorry. So I'm also looking for the book value first. That the book value of the pension assets is going to move based on the change from the opening balance by those figures in there, where we started with 26,600, then there was a minus 2,660, okay? Then there was a plus 2,380, okay? Then there was a plus 1,862, okay? So I have a 28,182 as my book carrying amount. 28,182. Now, yet the fair value on the same date, the fair value is 31,500. But the difference between the book value of 28,182 and the fair value of the same asset, pension asset at the end of the year of 31,500 is a remeasurement difference, which I'm picking, and I want to go first to calculate it and to establish what type is it. Is it a gain or loss on the pension assets? Okay, so mathematically, I'm looking at the difference between 31,500 minus 28,182. 28,182. So let's first get that mathematical difference on the calculator. So 31,500 minus 28,182. I have 3,318. 3,318. So that is a remeasurement adjustment. The question is it a remeasurement gain? Is it a remeasurement loss? Look at this. If the asset in the books was 28,000, yet in the market fair value they are 31,000. So there's a remeasurement gain on the assets. So I have a remeasurement gain on the pension assets. So my assets have gained, whereas in the books they were only 28,000. In the market they are 31, and I need to work or adjust them or carry them at that market value. So therefore, I have a remeasurement gain. I have a remeasurement gain. Okay, so having gotten that remeasurement gain and I had a remeasurement loss up here, I'm going to have my working number 5 now, which will be the net remeasurement adjustment. So working 5, the net measurement difference. And I'm going to compute it first. So I'm going to compute it first. So let me insert a table there. Okay, so we're saying that we had a remeasurement loss on the pension obligations, but a remeasurement loss on the pension obligations. And if I go back in the table to pick that remeasurement loss, that amount we had in table 1 was a remeasurement loss of 3,500. That remeasurement loss is a remeasurement loss of 3,500. It's a remeasurement loss on obligations. Okay, so 3,500. I'll come and put it down there. Working 5, 3,500. Yet we had a remeasurement gain on the pension assets. We have a remeasurement gain on the pension assets. Again, let's go and pick it from that table 2, whereby in table 2, our remeasurement gain on the pension assets is 3,318, 3,138. Okay, so let's go and pick that and put it down in our working. So that working is giving us another calculation. So do you realize that your remeasurement loss of 3,500 is bigger than your remeasurement gain of 3,318? So I'll have a net remeasurement loss there. Have a net remeasurement loss. My net remeasurement loss is the mathematical difference between 3,500 minus 3,318. Again, I'm going to use my calculator to get that net remeasurement loss. Okay. My calculator, I have 3,500 minus 3,318. So I have 182. 182 as my net remeasurement loss. So 182 is my net remeasurement loss. Okay. So what does that mean? That I have calculated it. The examiner will be very happy to say, I have gotten these are, I think, 3 calculations on this item alone. One, this student was able to give me a calculation here because that 3,500 did not come from the scenario. It was not directly written in the scenario. You calculated it. So there will be a tick. In the process, there's also a tick you've gotten there because that was also a calculation. The 3,100, that book carrying amount. Okay. So a student has a tick as calculation tick and the second calculation tick there. So those are 2 calculation ticks already. Then this same student on table 2 on pension assets has a tick for that calculation because it wasn't given to you. You had to calculate it, and also a tick for the calculated remeasurement gain. So those are 4 ticks now. Then the student directs the examiner or the marker that come and find 3 other figures in there. They will not give you the 3,500. They've already given it to you up. They will not also give you again the 3,318. They have ticked it up there. They will now tick a 182. This is now a new figure that they are finding, 182. Having ticked that, they want to see you now going ahead to say that I have computed it, Mr. Examiner, and you have given me that calculation tick or mark. I want to now go ahead to recognize it. So that net remeasurement loss is going to be recognized in the financial statements by debiting it in the OCI. In accordance with ICE 19, we shall take it to the OCI. That OCI is going to be debited with this net remeasurement loss of 182. Okay. As you do that, of course, remember that you have entries, and I'm going to start with the first entry, which was on the table for the pension obligations. That figure down there came because there was a 3,500, which was the remeasurement loss on the pension obligation. Okay, so you're coming in to pick it from the table, that table down there. Yeah. So you're crediting the remeasurement loss on the pension obligations with the 3,500. Okay, while the other debit is this remeasurement gain on the pension assets. So the assets gain, you debit them. So you have debited you are debiting the pension assets. So this is pension obligations. With that remeasurement loss, while this one you're saying with the remeasurement gain. So remember that the remeasurement gain in this case is 3312, that figure there. So I'll come and say 3312. So that's the double entry. The examiner is saying that this is in accordance with ICE 19. So you're working on the remeasurement difference is in accordance with ICE 19. So let me put that in. That this is in accordance with IAS 19 as the instruction is down there from the scenario we've read. So I want to post these 2 transactions. Debit the OCI with that net remeasurement loss. I'll go and have the OCI section. Remember, we've structured a summary table here. Okay, so here it is. So we shall say that we have a net remeasurement loss, which is coming from my working 5. I want to direct the person marking my script. Go to working 5, you'll find the figure there. And the figure you'll find there is 184. It is a debit entry, 184. Let's double check. sorry, 182, not 184. 182. Okay, so you have a 182. It's a debit entry. Okay, the credit, so the second debit, 3312, you've already posted it. I hope you remember when you had the table on the pension assets, we increased it to 3312. So that debit is already in our accounts. It's already in here. So it's already here. That debit is already there. Just like the credit of 3,500 is already in the table of the pension obligations. So we've just completed the net remeasurement difference going to the OCI as a summary. We've taken it there as a summary. So we are done. So the question is done. You may want to just come in to say that therefore our net debit amount in the P&L is the combination of the 2800 plus the 98. You don't have to do this. The examiner will not mark it. You only wanted to see the summary lines that will be in the P&L. In the current service cost, there will be a figure of 22,800. In the net interest cost, there will be a figure of 98. So maybe if you just want to complete to say that that in total is 2898, it's okay, but they will not mark it. They will not mark this here. But they will mark the two individual lines, the 2800 and the 98, they will mark them as summary line items that will appear in the P&L, or even the 182 will be marked separately as a summary line that will appear in the other comprehensive income. Okay, so let me just check if I have questions related to this question of Dan called Butera in the chat. Okay, so somebody is asking, is the interest income based on the discount rate of pension assets? Yes, you see, that's why I was asking you people, write these things as I was writing them. That question is good, by the way. It's very good, but it's just telling me that as I was repeating and repeating, the person who is asking that question may not have seen that we're saying that this is going to be based on the balances. One of the balances there is pension assets. So one of those is a pension assets, meaning that we shall use the same discount rate at the start of the year times the opening balance of pension assets to get interest income. Or we shall use the interest rate at the start of the year times the pension obligation to get the interest expense. Then we shall net the two figures to get the net interest income or net interest expense. So the answer is yes to that person asking that question. So it's discount rate on the pension assets to get the interest income. Okay. Okay, so I think those are the questions specifically on Butera that I see in the chat. Now, again, just as I get to another area, because we shall never finish, you know. We have so many topics to handle. So this question called Butera, use it for all the other questions you come across on IS 19 for defined benefit pension schemes. The only difference that's not in Butera, which I'll pick tomorrow, will be where I can pick a question that has a past service cost because you've not seen it. In Butera, you've seen current service cost. So the way you've seen it in Butera, it will be the same for all the questions, including your question, which I will also ever in future use as a revision question. That people open the May 2026 question, section A or section B. I'll tell them, you see that current service cost? Let's do this. So I'm telling you, go and do it. Because I'll tell those students that I hope those students did that. You know, I'm trying to tell the people who are telling me that now also open the one of next sitting. We shall not finish this because we have other key topics. So the people who are saying that, can you open the one of this other sitting? Go and open it yourself and do what you've seen in Butera for the current service cost because it's there. Okay, so what you are so far missing is the past service cost. You're going to see me doing a question tomorrow that has a past service cost in it. Again, we've done the net interest cost because it must come, and you've seen it in Butera. So people are saying, also open this other question, go and do what I've done today with you on Butera for net interest cost and do it there. The difference there will now be figures and the interest rate. Use now the figure there for pension obligation, the figure there for pension asset. If there's a past service cost, first adjust the past service cost. You get it? And then get the revised or adjusted open balance for the pension obligation times that interest rate. Calculate it. When you calculate, get the net amount, net interest income or net interest expense, then recognize, do the double entry. So similar to Butera. Now, again, contributions paid. Please don't go for contributions that are not yet paid, but they must be paid. Do what you've just seen in Butera to do that other one. You know, that's the reason of not being lazy. Now that you know, you go and be active and say, okay, let me try it out before he tries. So don't be lazy. The lazy ones never pass. The strong, active ones are now saying, Bruce, I wish you can finish and go to another thing, because me, I want to start using the space and time to do this question that was examined, say, last sitting, because you've told me what to do. If I didn't pass the last sitting, this is what I missed then. If I've not done A1.3 before, and I'm going to do it this coming sitting in May, then this is what I'm going to do when my question comes. Okay. Now, again, you've seen we've done pension benefits that have been paid or settled. So do that for any question you come across. Okay. Remeasurement adjustments. Be very careful with this. First, complete all the other transactions up and get your book carrying amount, and then compare it with the fair values or values they give you at the end of the year. Then compute that remeasurement gain or loss per item, either on pension assets and also on pension obligations. Then get the net amount to get the net pension, the net remeasurement gain or net remeasurement loss, and account for it. Or is in the other comprehensive income. Tomorrow, you're going to see me bring the asset ceiling. When I bring asset ceiling and past service cost tomorrow, then I would tell you the storage is completed. It is now waiting for you, especially the active one, to go and do yours. Yours will change the figure, will change the name. It will not be called Butera. It's going to be called another name. It will also change the date. It's not going to be 31st October 2021. It will be another date. It's not going to have the same figures. It will be another figure. So if you're taking this book or paper or document in the exam, you're only taking it to remind you of how to treat or double entry and where to present. It's not taking you to copy figure by figure, because the figures in your paper are going to be different. It's not telling you go and copy the dates as you've had them here in Butera. The dates are going to be different. How